You clicked on this video because you want to know if a target date fund is truly the right choice for your retirement savings. The reality is that while these funds are excellent for beginners, they often hide a significant drag on your long-term wealth that you cannot see on a statement. By the end of this explanation, you will understand exactly how a hidden fee structure and a rigid allocation strategy can silently erode your potential returns, and you will learn a specific rebalancing technique to fix it. Let us start by acknowledging why you likely chose a target date fund in the first place. The concept is elegant and has been validated by major pension reforms, including the 2025 updates in Chile, as a state-of-the-art default investment option. The idea is simple. You pick a year, like 2050, and the fund automatically adjusts your portfolio over time. It starts with a high percentage of stocks when you are young and gradually shifts toward bonds as you approach retirement. This mechanism is called a glide path. It is designed to reduce risk as you get older without requiring you to do any work. For someone who is new to investing, this simplicity is a massive psychological win because it removes the paralysis of decision-making. You feel safe knowing that the fund manager is handling the heavy lifting for you. However, here is the thing that most investors never consider. That automatic adjustment, while convenient, is often a one-size-fits-all solution that fails to account for your specific financial reality. The glide path is a rigid timeline based on your birth year, not your actual wealth or your personal tolerance for risk. As you accumulate more money, your ability to absorb market volatility changes. A standard target date fund does not know that you have saved enough to take a different approach. It continues to follow the same script regardless of whether you have $100,000 or $1 million in the account. This creates a situation where the fund may hold too much risk for someone who is already wealthy or too little risk for someone who needs to grow their portfolio faster. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This leads to a critical issue known as asset allocation drift. Even though the fund promises a specific path, the actual equity exposure can deviate significantly from the theoretical target. This happens because the underlying fund managers have discretion over how they implement the strategy. They might hold more stocks than the glide path suggests during a bull market or shift to bonds too early during a downturn. Over a 30-year horizon, these small deviations accumulate into a massive performance gap. You are effectively paying for a service that does not execute the plan it promises with precision. The result is a hidden drag on your returns that compounds silently year after year. Now consider the cost of this convenience. The fee structure in target date funds is often opaque and nonlinear. You are not just paying the expense ratio of the fund you see on the screen. You are paying a layer of fees on top of the fees of the underlying funds inside the target date fund. This is known as a fund of funds structure. If the main fund charges a fee and the underlying index funds charge their own fees, you end up paying both. This layered cost structure can erode between 0.5 and 1.0% of your annual returns compared to a low-cost index fund strategy. Over decades, that difference is not just a number. It is the difference between a comfortable retirement and one that falls short of your needs. There is also a psychological trap at play here. The simplicity of the target date fund encourages a form of mental accounting where you treat the fund as a black box. Because you trust the automation, you stop thinking about your portfolio. You do not rebalance when market conditions change. You do not take advantage of tax loss harvesting opportunities that could reduce your tax bill. You do not adjust for the fact that market regimes shift and that a static timeline cannot adapt to new economic realities. This passivity locks you into a suboptimal allocation that does not reflect the current market environment or your personal liquidity needs. You are effectively outsourcing your financial decisions to a schedule that was written decades ago. So, how do we fix this without abandoning the convenience that brought you here? The solution involves decoupling the logic of the glide path from the execution of your trades. You do not need to sell the target date fund and start from scratch. Instead, you can treat the target date fund as the core of your portfolio and use a specific rebalancing strategy to optimize it. The key is to stop looking at the calendar and start looking at your actual wealth and market volatility. Here is the strategy you can implement immediately. First, determine your own target asset allocation based on your current wealth and risk tolerance, not the fund's default schedule. If you have accumulated significant wealth, you might find that you can afford to hold more equities than the fund suggests, or perhaps you need to shift to bonds sooner than the fund's timeline indicates. Once you have that number, you do not wait for the fund to adjust. You manually rebalance your portfolio to match your target allocation. You can achieve this by adding a separate satellite portfolio. If your target date fund is too aggressive for your current situation, you can allocate a portion of your new contributions to a bond fund to bring the overall portfolio in line. If it is too conservative, you can add a stock fund to increase your equity exposure. This allows you to keep the automated glide path for your core holdings while actively managing the risk level to match your reality. You are effectively overriding the fund's rigid schedule with a dynamic approach that responds to real-time conditions. This approach also opens the door for tax efficiency. By holding your assets in a way that allows you to harvest losses, you can offset gains and reduce your taxable income. A standard target date fund does not offer this flexibility because it treats all your money as a single block. By managing the allocation yourself, you gain the ability to make tax-aware decisions that a blind algorithm cannot make. The result of this strategy is a portfolio that retains the safety of the target date fund's core structure, but gains the precision of a tailored investment plan. You eliminate the fee drag by ensuring you are not paying for unnecessary layers of management on assets you do not need. You eliminate the drift by manually adjusting the allocation to match your goals. You eliminate the psychological trap by staying engaged with your money without being overwhelmed by the complexity of managing it. This is how you move from a mediocre outcome to a maximized retirement strategy. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.